Ladies and gentlemen, boys and girls, welcome back to another episode of Strongman Personal Finance. Now, I just did a live stream analyzing Tesla's financial statements, and it dawned on me there's another great investment out there that isn't Tesla. This company has massive potential. This company is going to grow its revenue by 1,000% per year and basically take over the entire world. Ladies and gentlemen, this company that I'm about to present to you is GameStop. Now, if you haven't heard of GameStop, it's a store where you can go and buy old retro games and you can go sell your games for pennies on the dollar and then buy them back for a ripoff. And it's basically everywhere. If you haven't been to a GameStop, then you just, I don't know, you haven't been around. Now, there's been a lot of craziness in the stock market with GameStop because it's just such a great investment that all these young retail investors have just piled into it because they see the future that those suits, those losers, then Wall Street don't see. Obviously, young and inexperienced investors know better because they like memes and stuff, okay? So I'm going to prove to you that GameStop is a massively growing investment and company, and that you should throw as much money as you possibly can into this great stock. So we're going to look at the company's financial statements, and I'm going to show you why it's so amazing. So let's go ahead and dive right into GameStop and why you should buy it. Well, long-term investing. All right, so like my previous video, we're going to start with the balance sheet. Now, as I will reiterate, the balance sheet is a snapshot of the company at a point in time, and it has the company's assets, stuff that they own, their liabilities, and stockholders' equity. Now, looking at GameStop's balance sheet, we're going to do some analysis. So when you're looking, you always want to look at the assets, okay? They got cash, restricted cash, receivables, blah, 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 standard assets. And then you have their liabilities and stockholders' equity. Now, assets should always equal stockholders' equity and liabilities, which it does. So at least GameStop has decent accountants, right? Now, some ratios that I like to look at are the current ratio, which shows how likely a company is to pay its bills in the short term, the quick or acid test ratio, which is a more strict current ratio. It basically excludes inventories and prepaids. And we're going to look at the debt to equity ratio, which is going to show us how much debt relative to equity the company has. Or another way to think about it is investors and creditors have a claim on the company's assets. Now, creditors have a preferential claim on a company's assets if it goes bankrupt. So if you're an investor, if you own common stock in GameStop and you see there's a ton of debt relative to equity, well, if the company somehow goes bankrupt, which there's no way it could possibly go bankrupt, it's such a great company, then the creditors are going to have the first claim on the company's assets when and if it goes bankrupt, which it can't possibly do. So let's go ahead and do some ratios. So the current ratio, which says it shows you how likely a company is to pay off its short-term debts. You're going to look at total current assets, which for 2013 is $1.5 billion. Billion, that's a big number. That must be a great company then, okay? So we're going to take the total current assets, 1.5 billion, divided by total current liabilities, which is down here, 1,342. And I know we got some numbers and calculations here, okay? I know investing is more than just looking at a chart and drawing freaking lines. You actually have to look at a company. Sue me if you don't like it. Anyway, the current ratio, according to my expert calculations, is 1.16 if you round. Is that bad? No. Is it good? It's okay. You basically want a current ratio that's greater than 1 because if it's below 1, the company has more bills coming up than it has stuff to pay those bills. So that may mean the company may have to go into debt to pay their bills, which is not a good thing. So it's over 1, so I guess that's good. But let's include the acid test ratio, which is generally cash, receivables, and marketable securities. So we're going to exclude prepaids and we're going to exclude inventories. This is a stricter current ratio, and it basically says how likely a company is to be able to pay off its short-term liabilities, excluding assets, short-term assets that are hard to convert to cash, like inventory or prepaids. It's hard to quickly turn those into cash to pay your bills. So let's add up our current assets, excluding merchandise and prepaids. So we have cash and cash equivalents, 508.5. Oh, it's math. Yeah. Well, that's restricted cash. Let's not even include that. We have receivables. Wow. And then we have current liabilities. So their quick or acid test ratio is 0.45. That's below 1. That's not looking too good now, is it? But it's GameStop. You know, I trust Wall Street bets. They know what they're talking about. So this looks kind of bad to me. This kind of looks like this company may have trouble paying off its short-term debts because its short-term assets that it can easily convert to cash are lower than its current liabilities. I know, it's crazy. So, I don't know. But, you know, I still have faith in Wall Street bets. Let's see. Let's look at the debt-to-equity ratio, which basically says how much debt you have relative to $1 of stockholders' equity. So the more debt that you have, basically, the less likely you are to get any residual value if the company goes bankrupt. And the more debt you have, the more interest expense you probably have in your company. So to find the debt-to-equity ratio, you take the total debt, also known as total liabilities, divided by total stockholders' equity. Now, we're going to see what this amazing GameStop company's debt-to-equity ratio. And I'm looking at their financial statements, okay? These are financial statements. These are their published audited figures, not what idiots on geniuses on Wall Street bets are saying. So let's see what the debt-to-equity ratio is. And remember, the higher, the worse. You usually want between 1 and 2, but let's see what GameStop has. So total debt is $2,035,000,000, and total stockholders' equity is 4,367. Wow. So usually you want 1, maybe 2. You know, you want as low as possible. I mean, who wants more debt? This company has a 4.66 debt-to-equity ratio. That's pretty freaking bad. That means this company is pretty heavily indebted. And basically the vast majority of the company's assets, if the company were to become bankrupt, would go to the creditors and not the shareholders, like the people that are buying the stock. But whatever, you know, I mean, we just looked at a couple ratios. That doesn't really determine how good of an investment a company is. Let's go ahead and look at the income statement. So the income statement shows basically the company's profit or loss. And they actually show you 3 years of income so you can compare the company's performance over a couple of years. So I'm looking at GameStop, and if we zoom in just a tad, we have the company's revenues at the top. Now, keep in mind, revenues are not profits. Revenues are just sales that the company has made, but the company has to pay its bills. It has to pay the cost of its inventory. It has to pay operating expenses, has to pay interest and taxes if it's profitable. All that has to be factored in before you actually get net income, which is the company's actual accounting profit. So let's see how this amazing company's sales has changed over time. So starting on the very top line, in 2018, the company had $8.2 billion of sales. Now, you want sales and revenue to be going up. That shows that you have a growing company. That's a good thing. Let's see what happened to GameStop. Well, sales went from $8.2 billion to $6.4 billion in the course of 1 year. So sales dropped by what? God, $1.7 billion in 1 freaking year. But maybe they just had a bad year. You know, it's GameStop. Okay. So going from 2019, which had $6.46 billion of sales, in 2020, now it's $5 billion in sales. So I seem to see a trend here. It seems like sales seem to be significantly declining for this company. Now, if you were to invest in a company and you saw its sales dramatically dropping every year, would you consider that to be a good investment? Well, if you're on Wall Street Bets, you probably do. But if you're me, probably not. So let's see what percent the sales have dropped by in just 2 years. So we take 8285. Wow. Sales have dropped almost 39% in 2 years. That, ladies and gentlemen, is a company that you want to put your hard-earned money into. Not only are the sales dropping, but there's basically a massive amount of debt, which means if the company goes bankrupt, which it can't possibly go bankrupt because, I mean, sales are going down. It has a massive amount of debt, which means the company's assets would probably not be sold off and given to its creditors, right? But whatever, you don't have to worry about that. You saw a funny meme on the Wall Street Bets forum. That's all you have to do. All right, so gross profit. Well, at least we have a gross profit, okay? Your gross profit is this line right here, and that's just your revenue minus your cost of sales. So let's see what their gross profit margin has been. So in 2018, the company's gross profit margin, which is their profit just from selling stuff without factoring in operating expenses, is 8285 minus, I could just do this. Divided by 8285, 27%. Wow. Let's see how it changed in 2019. So in 2018, the gross profit margin was 27%. Let's see if that's changing. Generally, you want that to be like stable or increasing because that means you're making more money from the stuff you're selling. You're improving your processes or you're getting inventory cheaper and selling it at a higher price or whatever. Let's see how that changed. 1089 divided by 646. Oh, wow. It actually went up. That's very impressive. I might buy this company now. And then for 2020, we have, all right, so it went from 24 or 27% in 2018 to 29% in 2019 to 24% in 2020. So it's kind of just staying in the general range, but whatever. It's GameStop. You should just buy it and not even think about it. Now, the company is reducing its selling general administrative expenses, which is just like, paying for the headquarters, the CEO, support elements, basically. They don't actually participate in the direct buying and selling of inventory. So it looks like selling general and administrative expenses have been going down. They were almost $2 billion in 2018. They stayed roughly $2 billion in 2019, and they significantly dropped. So it looks like the company's downsizing. They're trying to cut costs. So they probably fired a bunch of excess people they don't need. So that's cool. But let's go ahead and see what their operating profit is. Oh, I see operating loss. So their operating loss for 2002 is $237 million. 2018, $4 million. And 2018, $7 million. So I guess if you're like a super positive person, you can see that they've had a loss. They've been losing money for the past 3 years, but at least the amount of money they've lost has gone down. Wow, it's quite the accomplishment. I'm really considering investing in this company. Wall Street Bets, funny memes, All right, blah, 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 blah. Net loss. So your net loss is like your bottom line profit or loss. So you have to factor in all your expenses before you get to your profit. Revenue doesn't matter. Revenue growth is good, but you can't just look at revenue as a sole metric for whether you should invest in a company. You want to see if it's profitable after all its expenses. So let's see what the amazing profit margin for GameStop was in 2020. So we had a net loss of $215 million divided by revenue of $5 billion. So they had a negative 4.2% return in 2020. Negative, but it's GameStop. Let's see what happened in 2019. So they had a loss of $470 million. They had revenue of $6.4 billion. Wow, they're decreasing their loss margins. Isn't that great? They're losing money, yeah, but they're losing less money every year, both in an absolute value and as a percentage. So I don't know. Maybe they're going to recover and take over the world. So that's that. So basically, we have a company that has massively declining revenues, and they've been having a loss for the last 3 years, which would totally entice me to invest in this company. All right, so let's go on. Let's look at their statement of cash flows. Now, as I've explained in previous videos, statement of cash flows shows you where the company's cash is going. This income statement here, this is based on accrual accounting, which means you recognize revenues when they're earned, not when the cash is paid, and you recognize expenses when they're incurred, not when the cash is paid. So this statement of operations is not cash. They didn't collect $5 billion of cash and spend $3.8 billion on their inventory. They actually earned revenue, but that was based on accruals, which you'll see in a second. It's basic accounting, but it can be confusing for some people. So let's go to their statement of cash flows, which shows where the cash went. Now, when you're looking at a statement of cash flows, it's divided into three sections. You have operating activities, you have investing activities, and you have financing activities. Your operating activities shows you where your cash is coming from and where it's going in relation to things that happen within the normal course of business. So buying inventory, selling stuff, paying your employees, paying short-term bills. That's going to all fall under the operating section. For cash flows from investing activities, that's when a company either buys or sells property, plant, and equipment, like the big things the company uses, buildings, equipment. Maybe they might invest in another company's stock. That would fall under the cash flows from investing activities. And then cash flows from financing activities, which is down here, that's when the company either issues or buys back its debt or issues or buys back its stock, and it pays dividends. So when you're looking at this, you want to first look at cash flows from operating activities. That's what the company does. Are they generating positive cash flow? Are they receiving more money from sales than they are spending on business expenses? You want to see that positive, and you want to see that growing. So let's see what GameStop has. So in 2020, they had $123 million in positive operating cash flow. So at least, I know they're losing money, but at least they have positive cash flow, okay? You go back the previous year, they actually lost $4 million. So they actually spent more on operations in cash than they received. That's not good. And then in 2018, it was $325 million. So this looks like a company that's barely staying afloat. You know, like they had it in 2018, they had some positive cash flow. Then it significantly dived. And then in 2020, they barely broke even. So I don't know. I don't see generally massive increases or decent increases in operating cash flow every year. I see a company that's struggling to survive. But did you see that last meme on Wall Street Bets? That was so funny with the apes and stuff. That means you should invest in this and not even think about it, because we're going to get back at the suits. We're going to get back at the suits, ladies and gentlemen. All right, so let's see what they're doing with investing activities. So generally when a company's, expanding, they want to build more factories, they want to buy more equipment, you're going to see a negative number. You're going to have cash flows used in investing activities because you have to buy crap for your business to expand. You have to buy buildings, equipment, yada, yada, yada. Now, when I see this, I see positive cash flows from investing activities. So that right off the bat is an indicator that this business isn't really worried about expanding right now. So let's see what happened. All right, so they're buying some property, plant, and equipment, but they're also selling it. And the main thing that sticks out to me is proceeds from divestitures, which means they sold a part of their business. They sold it and got rid of it, probably because they're struggling so bad that they needed an influx of cash. So they got rid of a crappy part of their business. That happened in 2018, and they collected $727 million from that. Yeah, I don't see much growth here, ladies and gentlemen. I just see a company barely investing in itself, barely surviving. So, but like I've said before, funny memes. Next, let's go to net cash flows used in financing activities. Now, when your company's growing, you're taking on debt, you're issuing stock because your investors want to give you money because you can use that money to, invest in the business, buy stuff, etc. Now, looking at net cash flows used in financing activities, I see a bunch of negatives. So what that tells me is they're probably paying off a lot of debt. So let's see what happened. Repayments of senior notes, that's debt. Proceeds from French term loan. I guess they took some loans from the French. Borrowings, repayments. So basically, they're bleeding cash for financing activities instead of collecting cash to use to expand their business. So I see a business that's not having a good time. But like I said, this is just a cursory examination of GameStop. The key thing I want you to see is if you go back to the income statement, which is my favorite statement, they've had a freaking loss for the last 3 years. They are not a profitable business. And even more worrisome is the massive decline in revenue year over year. This seems pretty freaking bad to me, okay? If a company has this much loss of revenue, they need to change how they function, how they operate. Because if that continues, the company is literally going to go to zero. Because who's going to want to lend money to this company that's obviously a dying dinosaur? In conclusion, it really pisses me off that people on Wall Street Bets are hyping this company. And they're elevating the price of this company's stock, simply to get back at the man, the hedge funds. But at the end of the day, this company is not sustainable. This company will probably go bankrupt unless some miracle comes and I don't know what they have to do to save themselves. But it pisses me off that all these young, impressionable investors are getting swept up into this garbage where they're throwing their money into a freaking worthless company. I bet you 95% of Wall Street Bets hasn't even looked at GameStop's financials. All they say is, oh, there's a funny meme. I guess I'll just invest in this company. It's going to go to the moon, yada, yada, yada. But that's just short-term garbage, okay? If you're investing in this company, you're probably going to get freaking screwed. So for the love of God, please don't invest in GameStop. I was being sarcastic the whole time. It's a garbage company. It is not worth your money. Please like, please subscribe. I'm about to go have dinner. You guys have a wonderful night.